Good evening and thank you for tuning in to You and Your Money. I'm your host Bryan, and in tonight's program we are focusing on estate planning, offering insights and guidance to help you make informed decisions. In last week's budget there were several positive changes. The annual tax-free saving contribution limit has increased from 36,000 to 46,000. The retirement fund contribution deductions remain at 27.5% of taxable income per annum, but the cap has increased from 350 to 430,000. The nation's tax exemption has risen from 100,000 to 150,000 per year. In addition, which I was absolutely shocked at, the foreign exchange allowance has been increased from 1 million to 2 million per individual without requiring exchange control approval. However, there were no changes to estate here. And joining me this evening are my resident guest, Harry Joffe, Head of Legal Services at Discovery Life, and Terry Berkowitz, attorney at Terry Berkowitz and Associates. Guys, welcome to the show. Harry, first question to you. Two hot potatoes we've had on the show. I'm going to let you deal with the one and I'm going to let Terry deal with the other. The first one relates to so many calls I've had about the falling away of a power of attorney. Now, we've discussed the concept. Yep. We've discussed curatorship. We've discussed all the things. The question people are asking, what do they then do when the power of attorney comes to an end, when the individual giving the power of attorney is no longer compos mentis?
Yep. I mean, Bryan, we have this all the time, obviously, at Discovery, because we have a lot of elderly clients. We have a lot of their kids managing their investments for them. And
Can I just stop you there, Harry? Do you check them?
We check them.
That's what I'm saying. There are a lot of organisations who don't.
That's
so you say you've got a lot of clients. So
our compliance team phone those clients every year. Phone them on the phone, they check, they understand what's in the power of attorney and they understand the consequences thereof. And if there's any issue, of course, the power of attorney is invalid. So a lot of these elderly clients, now you've got three choices, as we've discussed before, Bryan. Number one, and the most difficult one, is the curatorship, because that's expensive and of course it's time consuming and it's an ongoing expense because you need a curator to run the affairs and that curator has to be paid and it's normally an advocate. Number one. Number two, which we're finding a better option, if you can get that individual into a lucid moment where they know what's going on, you can create a trust, they can transfer their assets to a trust, and remember there's no tax consequences normally because there's a SARS ruling on that, and normally that individual is still the beneficiary of the trust. And that means they're not actually getting rid of the assets, they're just transferring it to the trust. But they're still the beneficiary, and it's normally a bevint trust, as we call it. So they still technically own the assets, although they're not running the assets. So you get the assets into a trust, and then the trustees can manage those assets.
Can the person who's given power of attorney, can they be a trustee?
Yeah, anyone can be a trustee. Of course, in terms of the master's requirements, you need 3 trustees, and they're independent and all of that. But anyone otherwise can be a trustee. And that's normally the best option. But again, you've got to get that individual in a lucid moment so they know what's going on. They can't transfer assets if they don't know what's going on. The third option we found, Bryan, which is sometimes successful, interestingly enough, the master, in terms of the Mental Health Act, the master of the High Court is able to give an administration letter to a family member to administer the estate. The only problem is there's a rand limit that they don't normally like to go above, and the Act actually does limit them. I can't remember what it is, Terry. I think it's R1 million size of this estate.
It's not very large. I mean,
We've had cases where the master's actually given it for slightly more than that, but again, it's not for huge estates. So those are the 3 options. I mean, the trust option is the best if it can work. If it's not too late and they do have some lucid moments, which they often do, or else you must try the administration.
Okay, so let's talk about those who have power of attorneys can see a family member really moving into dementia and deteriorating. Yes. So it's at that stage when they should really consider the trust approach.
Yes.
You say there's no CGT, the transfer of the assets into this trust.
Well, if it's a bevint trust, and again I'm throwing out fancy words, but a bevint trust really means the beneficiary has still got this right over the asset. So it's a bevint trust, you haven't actually changed ownership. All it means is the trustees on top of the trust are actually administering and running the asset, which is what you want. So then there's no CGT, there's no donations tax, there's no loan account because you actually donate it across.
Okay.
And there's a SARS ruling on that, Bryan, by the way.
So those who have, who are ready at the moment, have power of attorney, but their family members or the person they've got the power of attorney isn't capable, they're out of that loop. They then either have to apply to the master for a letter of administration or go to curatorship.
Correct. But even, I mean, you say out of the loop, you know, even these elderly clients who have lost their capacity often have lucid moments. And we've had a case where we got the individual in a lucid moment. We had the doctor there, we had the attorney there, certifying they knew what was going on. And then you can do the transfer quickly. I mean, that's not very simple often.
Yeah, but look, it's very important because, you know, we've discussed it over the last year and a half.
Yes.
Mervyn Messiah's book, Mervyn's been on, and we've looked, and you say, I know Mervyn made the comment about an enduring power of attorney, and I don't know.
The law does not allow for that.
But they have, I know they have gone to the, I think the Constitutional Court.
They've asked, the Law Society has made a formal, what's the word? There's a formal document out to Parliament. But that document's been out for over 20 years and Parliament hasn't acted on it.
Okay.
There is an application, just to add, that was launched, but it's been opposed by all the various ministers for the enduring power of attorney. So it's been
Application to
opposed.
change the law, Terry?
Yeah.
Okay.
Why would
Mervyn
they-
launched it with a few
When you say the
advocates.
ministers, why
Yeah.
would they oppose it? Doesn't make sense.
I'll
Okay.
tell
We'll
you,
have to
Bryan,
look at the
sorry,
papers.
it's not such a straightforward process because in the UK where they've got an enduring power of attorney, there's often fraud and there's often problems with it because that a power of attorney goes forever. And it's not so easy to then reject it if you have a fallout with the person who's got the power of attorney. So, I mean, I agree it's a solution, but it's not a straightforward
No.
solution.
I also want to just add to what Harry's saying in terms of pre-planning for this event. You know, kind of having either a trust, but you don't have to use a trust, obviously, because of the Section 7C implications, because of when you loan money to the trust, it attracts 7C. But a lot of clients are actually doing interest-free loans to other family members, which you can do because you're, again, also not changing the ownership. It will be repayable back to that person's estate, but it's allowing funds to be available in a different account, which the person who is non-compos mentis then doesn't manage. So the son has funds available. The wife can have funds available, again, from spouse to spouse. You're not triggering a tax event. So it's also about pre-planning and about opening separate accounts to prepare yourself for this so you don't have to maybe apply for curatorships. You know, it's obviously you have to have a lot of cash assets available to do that, but it is an option that is open to clients, and I highly recommend that they do it to plan for their parents' old age.
I think, Bryan, so the trust is very important. I mean, what Terry is saying is correct. If it's a loan to a trust, you have all those tax issues which we discussed, the 7C and all the para 7s. And that's why it's got to be a Bevint trust. It's so important that, where it's actually a vested right in the beneficiary. And there's a SARS ruling on that, so there's no tax consequences. But the trustee must be correct.
Okay.
Correct.
Well, I
It's
must tell
very
you,
important.
I'm pleased we've dealt with this, and I hope those who've been watching our programs regularly, who've asked the question on numerous occasions, are now getting some concrete advice of how you go about it. Terry, I mean, you do a lot of estates. Where a husband has left money to a spouse, to each other, and the spouse receiving the money is not compos mentis, what happens then?
Sure, that's a very tricky outcome. Yeah, because basically she wouldn't. Who would be the question is who would be checking that she's non-compos mentis, because the executor is actually in charge of transferring the assets. So again, you could use an option like a Bevint trust. I like what Harry was saying, because the ownership still vests with her. So that would be a good option for that wife, is to have a trust where she is the only beneficiary, where the tax consequences don't change, and the trustees manage it for her benefit.
Okay, I know we're not going to get through a lot of questions this evening,
Yes.
because there are some. This was one important issue. The other is you dealing with a lot of estates where monies are being left to children abroad.
Yes.
And there must be great complications because many of these kids left South Africa, but there are two possible situations. They left South Africa after having worked here for some time, so they were registered with SARS, but have not put returns in for years. The others is where children just left and never came back. Can you deal with both scenarios?
Yes, so I've had various different cases which deal with this. The first case was at Forex at a bank. I'm not going to mention which bank, but I was trying to get assets to beneficiaries who have left the country over 25 years ago, but didn't formally emigrate, and didn't finalize their immigration with SARS. And the one bank that I approached would not let me do the Forex payment to them without proof that they were non-resident. So there's a document that SARS issues, obviously, when you leave the country, to formally state that you are now non-resident. Why some people wouldn't want to apply for that is obviously because it incurs exit taxes and other admin costs. So in the absence of that letter, they are hesitant, because of exchange control, If there is not that letter, they still, to move money out of the country, you're still restricted by the strict exchange control rules, which, as you said, have increased to 2 million. But if it's a big estate and it's more than that, it becomes very complicated. So that bank refused to get the money to this heir. She's been living in Australia 20 years.
Did she work here?
Yes, before that, yes.
So she did have a tax number.
Yes, she had a tax number, but she hadn't ceased her tax residency here, which means her tax affairs were not finalised and weren't in order. So I decided to approach a different bank, and the other bank was satisfied with just proving that she was paying tax in Australia. So I was able to utilise her Australian tax return, and the bank was satisfied that because she's paying tax in Australia, I was then able to pay her. So the banks are, they're trying to get around the exchange control regulations, but it is different in every case. So it's really important that if your children are living overseas and you know that a large inheritance is going to be due to them, that they do formally financially emigrate and become non-residents for tax purposes, so that we can get the capital payments over to them.
So Harry, let's talk about that. Now, what is the process?
So Bryan, it's interesting. I was chatting about this last night to an individual who's been living in America for 20 years. He also never tax immigrated. And I said to him, why not tax immigrate? Because a lot of these individuals don't have anything in South Africa anymore. So when he left, he sold up, paid his CGT anyway. So if he tax immigrated, it's actually not such a difficult process because there's no tax to pay. So that's the
Don't
first
you have
point.
to reopen all your tax returns going back 20 years?
You would theoretically, but he's got nothing to reopen because he sold off all his assets when he left. So he's paid his CGT. It's just that what Terry's saying is correct. He hasn't formally tax immigrated in terms of SARS. But he wouldn't have to pay back any tax. He would reflect that year when he's tax immigrated, put in a tax return for that year, and he'd be done. But again, there are other issues because he's a beneficiary of a trust, and he's not so certain that would block money coming out of the trust. So there are a few knock-on effects. The other thing, Bryan, I think it's also important for these individuals in South Africa. They need to plan correctly.
I'm sorry, I'd like to pick that up after our break. We're going to take a short break, and we'll be back shortly.